Okay, everybody, welcome. This is the October 5th, 2015 Monday strategy session. We're going to discuss trade location here and how to align ourselves with the big players in the market and go with them instead of against them. As we can see here, I have a snapshot of the low, one of the lows, the retest lows of Friday, or Thursday or Friday, excuse me, Thursday or Friday that led to this up move. Okay, I had mentioned Friday that the market was getting into the levels, so I'm talking about the big picture level here. It was getting into the level now where they start to buy, where the markets are, the number of stocks that are actually bullish in the indices are so few that that's when they start to buy. And it ranges between 0 and 100%. 100% meaning of the 3,000 New York Stock Exchange chart stocks, listed stocks, all 3,000 are bullish, and 0% meaning zero. Well, that 0% happens in markets like the materials, gold, very, very thin markets. And when it gets down to those levels, that's when you want to start to look to buy. Again, trade location. That's because that's where the big investors start buying. Same thing with the indices. And you can take this on all time frames. So I'm going to first show you what it currently looks like. And if you ever want to get an idea of the big picture, this is the best way to take a snapshot of that. You go to stockcharts.com, you go to end of day summary, and you scroll all the way down, and it's a percentage called bullish percent. And you look at the New York Stock Exchange, because that's the largest 3,000 stocks. And when you start to get above this 70% threshold here, the market's overbought, okay? And institutions do not buy up here. When it gets beneath 30%, that's where institutions buy, okay? So buy zone. Let me see if I can get this to stick. Buy, and the top is sell. Or don't buy, right? You don't have to sell. And because there's a lot of institutions out there, the biggest ones, the biggest of the biggest, actually don't sell. So they'll let something go out of business and hold it, and they'll just window dress it, which is exchange it out for another stock. It's no big deal to them because they're playing the diversification, and they're just simply buying when the market itself gets cheap enough. So on Friday, we were entering into the 30%. Okay, 30% is the beginning of the buy levels. 70% is the beginning of the overbought and sell levels. And this chart here is going, this is 2010, this is 2011 through current, 2015, okay? These little numbers in here, this is September, October, November, okay, September, October, November, December, and here's January, February, there's March, April, May. So back in May of 2015, sell in May, that's when they were selling. So they've been distributing shares ever since May. Now, at the same time, they can also hold up the S&P. Okay, they can hold up the S&P because it's cap weighted, and it's really the largest percentages is Apple by far, and there's GE, there's Microsoft, and there's a few others, and it's about six total. 6 of the 500 is what controls the S&P. Okay, so they don't have to do much, and those are the most liquid and the largest anyway, so they can do what they need to do to hold the market up while they're actually selling. Okay, and these are the hedge funds that are selling and hedging and things of that nature. So at least need to be aware of the big picture at all times, okay? Even in your intraday trading. So let's take this down to the granular stage, into your 4-hour chart, your hour chart, your half-hour chart, your 15-minute chart, your 5-minute chart, okay? And the same process is going to happen on all time frames. Let me pause for a second and see if there are any questions. Some of you may have seen this for the very first time. Let me know if you're following. Again, we draw our 30 and our 70, and then what you also have is your midpoint, right? So now let's take this trade location. I'm talking about trade location here. Let's take this and forget about this is 2010, 2011. Now let's say this is 10 o'clock, 11 o'clock, 12 o'clock, 1 o'clock, 2, 3, okay? Now we're on the hourly chart. So now, again, above the 70%, a couple things. As they are right now in the current market, they are obviously above this level, right? And let's say this level was Friday's high, okay? This level was, let's say this level here was the overnight low, okay? And this is, say, the point of control, all right? So when we want to think about trade location, we want to go back to the big picture, and we want to outline levels. So these levels, based upon Friday high, point of control, overnight low, those are each trade locations. 1, 2, and 3. Now, if we are up above yesterday's high, and that's the trade location, what we're going to see is on the volume profile on the far right. Okay. Let me draw these again. And are there any questions so far? Is there anyone seeing this for the first time? Has anyone ever heard of this before? The bullish percents? Besides me. Besides hearing it from me. No? Okay. All right. This bullish percents are basically, see these X's and O's? It's price action. But then it's measuring every single 3,000 stocks that are on the New York Stock Exchange. And it's taking each stock individually. And when it's on a buy signal, it's when, let's say this is at 74, okay? It's an X going up, O's are going down. When the X column goes beyond that previous level, that's a buy signal, okay? So if all 3,000 of the stocks on the New York Stock Exchange are on a buy signal, that would read 100%. And in history, there's never been such a thing, nor has there ever been 0%. Okay? But on average, and this goes all the way back to, I mean, there are charts like this that go all the way back and studies that go all the way back. This is the oldest known representation of the markets. This is really, really old school. Okay? And this can go all the way back to 19th century. And it's all based upon, and it correlates to the current markets and all markets. Because what we're looking at is a standard deviation. Okay? We're looking at a standard deviation. And this is the mean and the median. These are the value area highs and the value area lows of the market. Okay? And again, the largest buyers are going to be buying at a discount. And they're going to be either selling or not buying up here. So this is overbought. Let's just call it overbought. And this applies to every time frame. So this is how we get big picture trade locations. So if you have retirement accounts, mutual funds, ETFs, things of that nature, when the market gets down beneath here, this is when you want to be buying. This is when you want to be adding to your IRAs, your pension accounts, whatever you're using for your asset classes. This is when you want to accumulate stocks. And it's the same thing with the institutions. This is when they accumulate stocks. And then now what I'm saying is I'm taking this same concept from the yearly perspective, and I can show you a chart that goes all the way back to 2000, but that's about as far as this one goes. This can go back many, many, many years, but a good 5-year snapshot is sufficient for the discussion today. And you want to have the same idea on whether it's a 5-year or an hourly chart. So you can take the same concepts and apply this to an hourly chart, or a half-hour chart, or a 15-minute chart, or a single bar. So we're going to find trade location, and basically you can chart this NOFT with a 240-minute chart, a 60-minute chart, a daily, a weekly, a 15-minute, half-hour. It doesn't matter what you use, it's all going to be the same. There's going to be a value area high, a value area low, and this is where the large players buy, and this is where they don't buy or they sell. But the one thing they don't do is buy up here. Okay? So Friday we entered into that buy area, the first leg of the buy area. You can see here in 2009, which was the bottom of the market, there were only 10% of the 3,000 were on a buy signal. Okay? In 2011, what was that? Let's just say that's 18%. So everyone probably here remembers 2009, and that was when the cash SPX went to 666, right? So the cash S&P now is, above 1900. So obviously that was a nice little buy, and that's when they were buying. But also you can see here, and this is something that you want to take into account for, again, is it a clear understanding that what I'm presenting here in this yearly this is multidimensional? The same concepts apply to your intraday trading. Have I gotten that clear? Yeah? Okay, great. So the same thing, let me clear some of this stuff now. Okay, so when we are above value area high, which we are now in the current market, today, all right, for today. But what you want to understand is you want to start to take a look underneath the hood. Okay, you want to take a look underneath just the 6 stocks of the S&P 500 that are working. So this is when you want to keep track of at least Apple and GE, okay? At least those two. And what you also want to take a look at is risk on markets, like the NASDAQ and the Russell, all right? And then lastly, what you want to keep your eye on is the 10-year market. So those are the markets where when you are up above the value area high for extended period, what you want to start to see is the migration higher of the risk on stocks. So if they're able to manipulate these 6 stocks, but yet the Russell, the risk on, and the NASDAQ, those start to fall away, then you're at risk that the S&P is not going to continue higher. So it's almost like you're taking an internal look at the market to confirm. So the Russell versus the S&P is 2,000 stocks. And of those 2,000 stocks, there's not one single stock that is, put it this way, all 2,000 stocks are more equally cap weighted versus the S&P. So it's a better, truer read. So it's kind of like you can look, just like when they're up here and they are taking the market higher on a price, but then they have been selling since May, which has led up to some nice down days, right? Remember, they have to hold up to market. They have to hold it up in order to get the best price for their clients. It's a must. Otherwise, the whole game stops. So whether they manipulate interest rates or the plunge protection team or whatever comes in, they're going to try to manipulate that while they're distributing out the shares. And the same thing is going to happen on a day like today. If we don't stay if we're staying above the value area high, but yet the Russell or the NASDAQ are starting to fail, then they're getting ready to sell the market. So this can give you a heads up of the trade location. Now, vice versa, if you stay above the value area high and the market is making a new high as it is right now at 1973, you want to look at the Russell and the NASDAQ to see if they're making also new highs, okay? Of the value area high is valid. So therefore, what you need to do is you have to be looking for those longs. And you're not going to get much of a retracement. So the trade location then becomes a little difficult. So if we're at this trade location, what you're looking for, you are looking for breakouts. But you're looking for breakouts after consolidation. Because in an up move like this, you're not going to get your deep pullback. You might get it a couple times throughout the day and that's it. But the majority is going to be spent accepting these higher prices and then breaking out. And the strategy on the breakout is so notice that even on say a 5-minute bar, let's say this is a 5-minute bar and you're playing a 5-minute breakout, the same strategy here is going to happen here on this 5-minute bar. There's going to be the median, the value area high, and the value area low. Now, one of the things that you can do is you have to understand that in order to get the market higher at this trade location, they have to entice sellers first. So they have to either leak the market first up. They leak it up. In other words, they will buy 1,000. Let's just say they buy 1,000, and then they'll sell 10,000, just to be able to run the stops. Then it will come back in, and they can do the same thing to the downside. They'll sell 1,000 to buy 10,000. And what you need to do is you need to anticipate this to occur. This is, I am, okay. You have to anticipate this trap to occur. In other words, you have to see it happen before you take the trade. Or you have to be willing to buy, and then if it goes against you, almost immediately goes against you, you have to close it out. So that trade location here is the most difficult one because you have to see the trap first. But what I want to spend time on right now is the easier trade and the more frequent trade, which occurs about 68% of the time, is say this is an uptrend, is the retracement long back up to value. That's just a horrible drawing. That's just horrible. And this is what it's going to look like. And I took a snapshot of usually Thursday or Friday. And this is when the S&P was at 1899 here. And if you take the same concept where they buy beneath the value, you can see here at 1899, this was an institutional buyer that was called out on the pit. And I'm speaking about the squawk box, the pit squawk box. It was announced there was a buyer here. Okay. Now the thing with the squawk box, with the retail squawk box that's available out there, they cannot call out the buyer until it's bought. The advantage of the institutions or the guys in the pit is they can see the guy, the broker, coming down off the phones with the orders. And they can scalp and anticipate that trade happening before it happens. Or we can wait for it to show up in the print. And this can show up in the print before they can announce it. Then I want you, so if you take, let me do a white line here. Let's just draw the value area low here and a value area high here and a midpoint. Okay? Taking this concept over to here. Now this was a 15-minute chart. All right. Yes, 15-minute chart, as you can see here. And there was another announcement at 10:30, and this was Smith Barney buying in the pit. And they bought here, and they bought here. I forget who this was. I forget who that was. But at the time when they're buying here, they're buying outside of the value area low of this range. And the value at the time was this COT, commitment of traders. And when this opened and drove down, this here was naked. So this value, there was, see how it ended here at 0 and 184? See how it came all the way up to the tick, to this value spot? Again, the market is always going to chase value, and the institutions are going to be buying down here. And if they get follow through, then yes, they can buy more after they've checked value, come back in, and they buy again. And obviously, they were buying from 1899, 1908, 1909, and we're now at 1970, a day later. So the same concept on the longer time frame to find your trade location applies intraday.